Welcome to the McKonly Asbury webinar series, and thank you for joining us. The following presentation is from a webinar titled Current 401k Trends and Risks, originally produced on April 24th, 2014. The presenters are Dan Sturm, along with fellow colleagues Shalane Cohen and Danielle Guinter, all with McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for information about our future events and upcoming webinars.
Thanks, Reed. We have a large group of participants on this webinar, and we really appreciate you taking the time to join us. McKonly Asbury has a dedicated team that specializes in employee benefit plan audits. We currently audit 50-plus benefit plans, including defined contribution, defined benefit, health and welfare, and ESOP plans. We're also a member of the AICPA Employee Benefit Plan Audit Quality Center. I'm Dan Sturm, and I have about 10-plus years of experience in auditing and working with employee benefit plans, and almost just as much time working together on these plans with Danielle and Shalane.
I'm Danielle Guinter. I have 8+ years experience auditing employee benefit plans, as well as providing audit services to our manufacturing and retail service clients. Previous to working at McKonly Asbury, I worked as a 529 and retirement plan specialist at Merrill Lynch.
Hello, my name is Shalane Cohen. I have been with McKonly Asbury for about 9 years. I have been working on employee benefit plans for 6 of those years, working on 401ks, ESOPs, and defined benefit plans. When I'm not working on benefit plans, my focus is on manufacturing clients.
Thank you, Danielle and Shalane. We have seen many different types of plans, findings, and best practices. Please do not hesitate to reach out to one of us for guidance. Our presentation is designed from the perspective of a plan sponsor, whether that be someone from Human Resources, Finance, or even the Retirement Plan Committee itself. The discussion is based on questions we receive from clients, common plan deficiencies as reported by the DOL, and our team's research of the industry. Today we hope to look at current trends and risks related to employee-sponsored 401k plans. The discussion will include current fiduciary accounting, fraud risk and trends that will assist plan sponsors in planning for 2014 regulatory filings. At the end of the discussion, we have also allotted time for Q&A with our presenters. With that being said, Shalane, would you like to begin our discussion?
I would love to. Based on a description of this webinar, we assume that most of the participants on this webinar are included with 401k plans to some extent. And I bet there are some fiduciaries of their company-sponsored plans as well. If any of our participants are unsure, could Dan or Danielle, one of you, explain for them what a plan fiduciary is?
I'll take this one, Shalane. In short, fiduciary status is based on functions performed by the plan, not just a person's title. One person must be named as a fiduciary in every plan.
So if one of our participants is not named in the plan, does that mean that they're not a fiduciary?
Just because you're not named in the plan, you are not precluded from being a fiduciary. You need to examine your functions performed for the plan. Some examples include trustees, investment advisors, and members of the administrative committee. If you think you may be a fiduciary, but you are not certain, you should discuss and meet with your plan advisors, including attorneys, and clearly understand who would be considered a fiduciary for your plan.
Now, Dan, you've mentioned some people internally that should be involved with the plan. Can you give me some examples of different service providers to the plan that would generally not be a fiduciary?
Sure. Examples of that would be your ERISA attorney, or your accountants or your auditors, or even actuaries. They would not be considered fiduciaries.
Now, regardless of fiduciary considerations, who in my company should be involved with the plan from various different perspectives?
In our experience, the best run plans include retirement plan committees that consist of at least personnel from Human Resources and Finance. 401k plans often delegate to Human Resources since they are considered an employee benefit. However, the plans also include a financial component and unique reporting requirements. We have found that when Human Resources and Finance work together, especially on the committee with others, there's a better understanding of the plan, the risks, and a more efficient resolution of issues and concerns. As the auditors of these plans, we have found that the auditors are completed in a much shorter time frame. Access to the information reports is typically well understood by the group, as if one person is not aware, another may be.
Now, some of our participants may be sitting here and realizing for the first time that they are in fact a fiduciary of the plan. If they're realizing that, can you tell them a little bit what responsibilities come along with being a fiduciary of the plan?
The most important thing about a fiduciary is that they act solely in the interest of the plan participants and the beneficiaries. When making decisions, the plan participants and beneficiaries should be the focus, whether that be for investments or other matters related to the plan. Always consider the participant first. When we do our audits, whenever we have a question with each other, we always consider the participants and what the effect is on a participant.
And Dan, I just want to add real quick. This may seem obvious, but as you're talking about acting solely in the interest of the plan participants, some of the conflicting factors may be the company or the plan sponsor or the service providers or the plan administrator personally. And those things all need to be taken out of the equation when you're making decisions for the plan.
I would agree 100%, Shalane. Just to get back to what I said and to highlight what you said, we're looking at the types of investment decisions that are being made, the types of investment expenses, losses that are being incurred by the plan. These are all things that need to be considered on a regular basis if you're considered a fiduciary to the plan.
You also need to make sure that the participants are paying reasonable expenses. I was just reading about this court case where it was actually found that the service provider was not charging reasonable expenses, but the verdict actually fell on the plan sponsor because they found that the plan sponsor wasn't evaluating the compensation on a regular basis, and they also weren't comparing the compensation to other providers as a benchmark. So it's really something the plan sponsor wants to keep in mind.
Dan, you mentioned previously that the participants are paying expenses. Are participants paying expenses in all plans?
I would say in most plans, participants are paying some expenses. It might be a little, it might be a lot. But the type of expense will be determined by the plan document and the type of expense. Every plan has things like plan admin fees. The third-party administrator charges to the plan or the sponsor. The sponsor usually determines that at the adoption of the plan, whether they want to pay for it or if they want to have the participants pay for it out of their plan. We have individual service fees like loans. Most plans that we see these days offer loans. Typically there's a loan service fee. It's minimal, but probably about $50, $100. Give or take a few dollars. That's often paid by the participant.
Now, Dan, how would the participant know that there would be charged these fees?
The plan document should be available to all participants. So all that information, including a plan summary that the sponsor should provide as well. That information should all be in there when you sign up for your plan. Another type of fee that a participant may see is investment fees. The one thing about investment fees is some are obvious, some are not obvious. There's been a lot about fee disclosure, which we'll talk about more later. But basically, they're not as easy to follow because there's some investment fees that are charged on top to a sponsor or to the plan. Then there's other charges such as management fees, surrender fees, or trading costs that may be buried in your gains or losses that show through on your investment statements. So to summarize, there may be fees that are paid by the sponsor, but in most plans, participants are paying some level of fees. It's just a matter of how clearly it's communicated and how well the participant understands the plan.
And you know, Dan, I'm not sure if you realize that or if some of our listeners listening right now, the DOL actually has a great booklet, Understanding Retirement Plan Fees and Expenses. So if you wanted to get an additional background on this, that's a really good resource.
All right. So, Dan, previously you mentioned that having reasonable plan expenses was a fiduciary responsibility, and that's really been a hot topic recently. Can you give some insight on how to determine if the plan expenses are reasonable?
Sure, Shalane, thanks. The most important part of this is to have a process for making fiduciary decisions and following it, especially having a policy to survey potential providers, whether that be a third-party service provider or other type of provider, you want to have a process documented. So when it's time to make decisions about your service providers, you follow that process. Whether that's you want to look at 3 providers when considering expenses to say that that's reasonable, that's up to each plan sponsor. The DOL doesn't tell you you need to look at 6 providers and pick the lowest cost. In fact, the premise behind this is not low cost. They're not looking for you to find the cheapest service provider and have your participants pay the least amount of expenses. The DOL basically wants you to do what's best for your participants, which may not always be the low-cost service provider. As we mentioned before, the DOL wants you to put the participants first in all your decisions. And so when you're making these types of decisions, as long as it's evident that you put your participants first, you should be in good shape.
Now, Dan, as you're evaluating these service providers in order to make the decision about which one you're going to use, what kind of information is important for you to get from the service providers in order to make that decision?
The most important thing that I can stress to everyone on this call is to understand what exactly the service you're receiving. It sounds simple, but every service provider might provide a different level of service. So I would stress the importance of just understanding what each service provider is bidding or proposing that they're going to provide to you, and make sure you're clear that you're comparing apples to apples.
And just to add to that, if you don't have a good understanding, you may end up getting hit on the back end with a whole bunch of extra fees for services that you thought were included. So that's a good reason to make sure that you understand
You may have extra fees, and you also may realize months later that they're not doing something you thought they were doing. And as we talked about fiduciaries in the past, your fiduciary responsibility is to understand what your service providers are providing.
The DOL has also really been focusing on plans where they think that the participant has been paying higher fees compared to other plans. So if you are actually examined by the DOL, you'll be in a better position with them if you can actually answer all of their questions related to the expenses. So that's another reason to make sure that you're really understanding what fees are being paid.
Well, and I think the key is too, it's very important to have a process for making these decisions, but equally important is documenting that, because if the DOL comes in and you can't prove to them that you went through this process, then it essentially didn't happen. So it's really important to make sure you document that as well. Okay, so now as a plan fiduciary, you've gone through the process to select a service provider. You've documented that process. At this point, as a plan fiduciary, can you just go into autopilot mode related to fees from that point forward?
Absolutely not. A fiduciary is always a fiduciary from the time they start with the plan until they're no longer associated with the plan. They must continue to monitor everything with the plan. So that's the decision of the plan sponsor on how often things are looked at. But I would recommend, at least biannually, if not more frequently, that the investment committee meets or fiduciary is discussing with management fees, maybe what fees were for the current quarter. There might be an unusual quarter with fees that pop up. I would expect a fiduciary to be aware of that and understand it and be able to answer questions that will likely come up from the auditors on such fees. So it never really finishes. So yes, you may have made a great decision in selecting your service provider, but your continual understanding of the fees and expenses and what they're doing is expected as a fiduciary.
A question that we get a lot from our clients who may not have an investment or advisory committee, they want to know how you should go about starting one of those. What does that look like?
I would start this discussion by saying if you don't have a committee, whether that be a retirement plan committee or an investment committee, some sort of committee that is monitoring these plans or monitoring your plan, it should be a priority. So if you don't take anything else away from this conversation or this discussion today, you should take away that. Anytime you sponsor a plan, I consider it as an auditor to be a critical item to have a committee that is taking care of a lot of these responsibilities that we've already discussed in this plan. The lack of a committee only increases your risk of a lawsuit. There's lots of opportunities for lawsuits from plan participants. The committee can talk about risks, and things like that are going to help mitigate that risk. People that should be involved in these plans, we've seen all different types of involvement of the plan. It can be executives, and probably should include some level of executive management. It should include representatives from human resources, finance, basically anybody that you think is going to have some valuable information to add to the plan, to administering the plan, to making decisions on providers, investments, and other types of things like that. But if I can't emphasize enough, just having that committee is a huge step in the right direction to make sure you're administering your plan correctly.
And I think that goes back to something that we talked about before about documenting the policies that you have in place. I've seen time and time again that for plans that don't have a formal investment committee, that doesn't necessarily mean that they don't have a group of people that are meeting and talking about the risks of the plan and how they're going to move forward. But when they don't have a formal committee, they're not having formal meetings on a quarterly basis, and those discussions aren't being documented. And if they're not documented, the DOL isn't going to know that that's happening.
I would agree with you 100%, Shalane. As far as documentation, that is key, because if the DOL ever comes knocking at your door, that documentation is going to be your only evidence to support your looking out for your participants. That's what they want to see. If you show evidence of that, your risk significantly decreases that you end up on the wrong side of a lawsuit. Keep in mind, the DOL is not out there just to get you. They want to help you. There's a lot of resources on their website and other websites for that matter of how do I start a committee? Who should be in the committee? What should we talk about? How often should we meet? The DOL provides those resources. Also, don't forget you're probably paying an investment advisor. Use the resources you're probably paying for. Ask questions. Ask us as the auditor. We're glad to help. Just as the DOL, we're not out there to find problems with your plan. We're there to audit, and we want to act as an advisor and help you make sure your plan's running efficiently and under regulations as well.
And Dan, you mentioned the investment advisor. I think that they're an important person to involve in those committee meetings as well.
I would absolutely agree. They can offer a lot of insight into your investments, things that the average committee member or average member of management may not be completely aware of. So again, the advisor is receiving some sort of fee for their service. Take advantage of that service. I think just like us, they would prefer you ask the questions up front, pick their brain for knowledge, and make sure that you're using them as a resource to do the best job running your plan.
Okay, so at this point, as the fiduciary, you have gone through the process of selecting your service provider. Now you're monitoring through your 401k committee that you've set up. At this point, are you good to go?
Well, there's one large piece, and that large piece is making sure you communicate those fees to participants. If any of those on the call that have been involved with their plans for the past couple of years, you will recall that there's been a lot of discussion about fee disclosure. That is a huge key and now required to make sure participants are aware of the fees they're paying, what they're for, and I would fully expect in the future that fee disclosure is only going to increase and become clearer. So while your third party may take care of that for you, it doesn't necessarily relieve your responsibility. The plan sponsor, the fiduciary, or committee needs to make sure with absolute certainty that the fees that are required to be disclosed are being disclosed, even if they are not the ones specifically disclosing those to participants.
Okay, so the plan participants need to receive all of this investment information about their options and the fees before they ever start participating in the plan. How often, once they're participating in the plan, do they need to receive communication about that?
As I previously discussed about fee disclosure, that fee disclosure is required at least annually. So at least annually, every participant in your plan should receive some information related to the fees that they're paying for their investments. And we discussed some of those fees earlier, so it might be loan fees or administrative fees, but that participant, each participant in the plan needs to be disclosed to which fees they are paying out of their investments. The big piece of that and why this came to fruition was the DOL did not think that plan participants fully understood the impact of even a small fee on their plan investments and their retirement. Even something as small as 1%, participants were not fully aware of what impact that had on their retirement account and how significant that impact could be.
And one thing to note that is if you are audited by the DOL, they will expect to see all of those communications that you've sent out to your plan participants.
So one of the things that we've heard a lot at some of the conferences that we've been at, specific to employee benefit plans, is that plan administrators, when asked a question, may say, oh, my third-party administrator takes care of that. Dan, can you speak a little bit to that? When you transfer a process or a task to a third-party administrator, does that alleviate your responsibility to monitor that?
It may reduce your responsibility, but it doesn't completely eliminate your responsibility or the risk to the plan sponsor. It goes back to understanding at what point the service provider's responsibility picks up and yours ends, and vice versa. But I think it's fairly safe to assume that on nearly every plan that you can never completely mitigate your risk as a plan sponsor or fiduciary to the plan. You always need to act in the best interest of the plan and the plan participants, and simply hiring a service provider to take care of a certain process does not mitigate that risk.
Okay, so at this point, I think that we've established that if you're sitting here listening to this webinar and you're a fiduciary, you cannot pawn that fiduciary responsibility off to someone else. So I think we want to hear a little bit about what type of IRS and DOL communications have been seen recently so we know what to be aware of.
Shalane, one of the items that I've noticed since the DOL started using the EFAS website is instead of selecting a plan to do a full-fledged audit, they'll actually just pick one item on the 5500 that kind of stands out to them. Recently, they sent out letters to a sample of plan sponsors that had filed a Form 5500 for a retirement plan, but not for a health and welfare plan. And in some cases, this was fine. Maybe the health and welfare plan was filed under a different EIN number, or maybe the plan didn't benefit more than 100 employees. But in other cases, they actually did find that some plan sponsors were delinquent in filing those Form 5500s. At that point, they recommended they went through the Delinquent Filer Voluntary Compliance Program.
Danielle, can you explain a little bit about what that program that you mentioned is?
Sure, it's a great program. It actually allows plan administrators or plan sponsors to get back in compliance with their Form 5500 by paying a smaller civil penalty. Another inquiry that I've seen the DOL do is a compliance inquiry when they've noted on the Form 5500 that there was a significant drop in participants from the beginning of the plan year to the end of the plan year. So they've sent out a letter to the plan sponsor asking them if they performed a partial plan termination analysis.
Danielle, can I just interrupt you for a minute?
Sure.
You just mentioned a partial plan termination analysis. Is that something that plan management should be doing every year, or are there certain triggering events that should indicate that plan management should be doing that analysis?
That's a really good question. So I would say a triggering event is if you've laid off any part of your staff, or you've maybe sold off a part of your business. Typically, there isn't like a set number in the guidance, but the typical threshold that I've seen used is 20%. And at that point, if you determine that you do have a partial plan termination, then you have to 100% vest your participants in any employer contributions.
Now, would that be all participants, Danielle?
All participants affected by the partial plan termination.
Now, who should be, I guess from a plan sponsor perspective, who should do that analysis, and I guess who should they involve in that process?
Well, because that's another good question. Because the partial plan termination guidance doesn't have a specific threshold, I think you want human resources and your finance department speaking. I think you want to involve your auditor, and if you have an ERISA attorney, I think it would be good to involve them in that as well.
I think from the standpoint from the audit standpoint of things, I don't remember a case where we've ever had even just a discussion that there might be a partial plan termination. We've recommended that our client get involved with their attorney because they're usually close. It's usually not a black and white situation. So it's usually a little bit more than plan management can make that decision on their own, and us as the auditors can make that decision. So I would say in every case that I've seen, we've always recommended get the attorney involved, even if it's a no answer. At least get them involved and have that discussion And again, as we've said, document that discussion.
That's exactly right. I've seen where they have come to the conclusion that they did not have a partial plan termination analysis, but in order to prepare for possibly getting the question, they had their attorney draft just a quick memo for them to keep on file.
And I would just say, too, we've been talking a lot about an ERISA attorney here. If you don't have one, getting in contact with an attorney just so you have a go-to person is a good thing to start before you need one. And we have a couple attorneys that we've used in the past too. So if you're looking for one, feel free to reach out to us and we can put you in touch with someone who can be there to assist you if needed.
And I would say, just to add to that, Shalane, just about the attorney. I know I'm sidetracking a little bit here, but attorneys are useful for these plans for all sorts of matters. What our clients have learned to understand, and what we've learned to understand, is the DOL doesn't necessarily care about the actual dollar amount. So it might seem like a small, relatively non-material amount or insignificant amounts of the plan, but the DOL doesn't necessarily look at it that way. So if you have a small amount that, again, might affect one participant negatively, the DOL there might be fines associated with that. So it's worth having a 15-minute discussion and having that attorney on speed dial so you can have those conversations, document that you thought about it and you were acting in the best interest of the participants.
All right, so now let's circle back to a couple more DOL communications that you've seen or hot topics.
The IRS recently wrote an article about something they were seeing on Form 5500s as well that I thought was interesting. So on page 2 of the Form 5500, you're required to put what they call pension codes. It's usually the number and the letter that you're probably familiar with seeing, but maybe you haven't really thought too much about because it hasn't seemed that important. Well, it is important because basically what the IRS was seeing is that some 401k plans were listing a pension code of 3C on their Form 5500, which is an automatic red flag to them because 3C means it's a non-qualified plan. And as we all know, a 401k plan is required to be qualified. So this is just like a perfect example of making sure that you're actually reviewing your Form 5500 and not just taking it from your service provider and uploading it to the EFAS website, because at the end of the day, it's your Form 5500 and you're going to be the person that's responsible for answering any questions on it.
You know, something that I just saw the other day related to the 5500, and I think that it's a lot easier for them to pick up on things now that they have eFast, is I saw that one of the plans I was looking at online had terminated their prior actuary. And on Schedule C, they didn't indicate that they had terminated that. Can you speak a little bit to that? Like, is that something that has to be included, or is that optional?
You are required to disclose the reason for any termination with an actuary or an accountant. And the interesting thing about that, Shalane, is you're also required not just to put the reason on the Form 5500, but you have to disclose that reason to the prior accountant or actuary that you let go, so that they have the option to respond to the DOL directly if they don't agree with something in your reasoning.
There's one thing that I remember hearing, there was a lot about it a couple years ago. I haven't heard about it as much recently, but late remittances to the plan was a hot topic there for a while.
And Shalane, that continues to be a hot topic of the DOL. And just to kind of remind everyone on the call, basically what the guidance says is any contributions to the plan are required to be remitted as soon as administratively possible. Now, they do say, but no later than 15 business days in the following month. But it should be noted that's not a safe harbor. So if you've shown that you can remit contributions within 2 days, the DOL would expect you to remit all contributions within 2 days. And something interesting with that is I've seen where someone has disclosed in their financial statements that they did have a late remittance, and they noted that they self-corrected it. Well, they got a letter from the DOL saying, hey, we noticed that you self-corrected your late remittances. Have you heard about the voluntary fiduciary correction program? So, and for anyone who isn't aware about the Voluntary Fiduciary Correction Program, you actually fill out an application and remit it with how you corrected the issue to the DOL, and they'll then turn around and send you a no action letter, basically saying you won't have any further penalties and your plan won't be selected for audit because of you going through the VFCP.
And I think that's just another example of the DOL not just trying to get people and find people. It was an effort taken on by them, and they've spoke to us at various trainings that we've been to. They just want to make sure the plans get things done right. So this is another opportunity that they are offering to self-correct. So they're not out there finding you and charging you absurd penalties if they have to come in and find it. So it's more of an encouragement to say, hey, let's get this right. Let's work together. The one thing just to point out with Danielle's conversation about late remittances, the example she used was for large plans. There is basically a stated day amount to contribute on small plans, less than 100 participants, which she was referring to as soon as administratively possible, refers directly to large plans. And is as much as us auditors would love for them to just give us 5 days, 7 days, 10 days as a benchmark, they're holding true to their stance that if you prove you can get it in 1 day or 2 days, or what we're seeing a lot of now, 0 days, basically it's remitted as soon as payroll's processed, you're basically setting your own standards, and that's what they're going to hold you to.
And that's something too, if you have concerns, you're sporadically remitting those employee deferrals, from 2 days to 7 days. That's probably something that we'd recommend you talk to your attorney about to, establish what is as soon as administratively possible for our plan to help you have a starting point going forward.
And I would say with these corrections, I don't think I've ever seen a voluntary correction where it resulted in any absurd fee. It's usually pennies on the dollar or a few dollars per participant. Quite honestly, getting through the process and taking the time to figure out the correction is probably much more costly than the actual check that a sponsor is going to have to cut to make the correction. So we're not the voluntary correction doesn't mean you're going to have to cut checks for thousands or hundreds of thousands of dollars. It's a very reasonable fee, and it's usually just made or calculated to make up for lost earnings. So that's basically how it's calculated. So if you think you have an issue, my recommendation or our recommendation typically is we think you should correct it. It's not going to be too costly other than your time. If you disagree with that, we would then recommend you talk to your attorney and just get their buy-in for whatever decision you make. I've seen it go both ways, but we have seen it. So that's our recommendations.
So we've talked a little bit about the VFCP and how going through that program you can get a letter that basically says you're okay. There is also an option to self-correct. Danielle, is there a risk if you identify an issue and you self-correct and put it on one of your supplemental schedules? Is there a risk that you'll be more likely to be audited?
Well, the one thing that you want to keep in mind is if you have a late remittance, you're required to disclose that whether or not you correct it or not. So I would think in that situation, it would be a lot better to self-correct as opposed to just note the late remittance and note that you didn't correct it. I think people sometimes get overwhelmed by the VFCP application, but I've helped several clients with it, and they actually are not that time consuming. So I would obviously recommend going through the VFCP so you can get that no action letter. But if for whatever reason that's not a choice for you, definitely self-correct as opposed to doing nothing.
I can also speak from our experience. We've helped several clients through the years with this correction process and that have disclosed the correction process. And I can speak for our base of clients and people we've worked with. I have not seen any increased risk of audits with them. I have not seen, okay, because I put this on the form, now I'm audited. I have not seen any correlation with our clients between those findings or the correction and them being selected for an audit.
That's good to know. So we've talked a lot about DOL and IRS communications. If a plan is to get audited, what can plan manager expect that to look like?
Well, there are usually 3 reasons why you're going to be selected for audit. 1, your plan was selected randomly, so lucky for you. 2, there was something on your 5500 that stood out to them, similar to that pension code issue that I discussed earlier. Or it's a result of a participant complaint directly to the DOL. They'll likely examine your plan at that point. The one thing to keep in mind is, we talk about the DOL and the IRS. Both of them can select your plan for audit. Typically, the DOL is really concerned about the participant. One of the things I mentioned earlier was the fact that they are targeting plans where it seems like the participants are paying higher fees than they would expect. The IRS is concerned that your plan is staying in compliance from an operational standpoint. So are you adopting timely amendments? Are you doing your discrimination testing? If you are doing your discrimination testing and you failed, are you correcting it on a timely basis? Are your hardship withdrawals being done in accordance with your plan document? Are your contributions to the plan within the IRS thresholds? Those are the type of items that they're kind of looking at.
And what kind of communication do you typically get notifying that you are subject to audit at this point?
Typically, they'll notify you by letter, and they'll ask for information up front. Some of the examples of the information that they might request is plan documents and amendments, payroll deduction reports, summary annual reports that are provided to the participants. They'll basically ask you for any communication that's been provided to the participants. So be prepared to provide a lot of information. They'll also focus on fidelity bond information. They want to make sure that you have the proper bonding. They'll look for an investment policy. I think you were speaking about that earlier, Shalane. They'll look for committee meeting minutes. They will look for your discrimination testing. So there's going to be quite a bit of information that you're going to have to pull together.
The bottom line, I guess to summarize what Danielle was saying, everything they're going to ask for typically relates to the benefit of the participant, which I know we've highlighted a few times. But that's essentially what they want to make sure. They want to make sure the participants are taken care of. You're doing things in accordance with plan documents. The biggest number on the benefit plan financial statements is the investment number. So while they care about the value of the investments, the focus point is on the participants' portion of that investments, and do they have the correct portion, and are you doing everything correctly? So again, it always comes back to the participants, which is why if you're one of our clients, we have so many questions about how the participants are impacted by certain transactions.
And I think one thing to add is, sometimes they may ask for information with a pretty quick turnaround. I think I've seen, a 10-day window. And I've had a client who, for various reasons, couldn't meet that deadline. So what they did is they responded to them and just said, hey, can we get an extension? And the regulatory agency was more than willing to extend them another 10 days, which enabled them to pull together all the information that was necessary. So that's something to consider too. Like if you are getting stressed out about the time crunch, don't be afraid to reach out to them and see if that's a possibility.
And that's a really important point, Shalane, because asking for more time is so much better than just, I'm just going to send them what I have. If you just send them what you have and you specifically don't put together something just because you're not sure about it, that's going to be a red flag to them right there, and they're going to ask for even more information from you.
Or send someone out to visit you.
Exactly. And the last thing that I want to mention is the IRS, when they've been doing their examinations, have really been focusing on the internal controls that you have in place at your organization. So you really want to make sure that you are documenting these, because they will ask for them, and they want to make sure that you have controls in place to either prevent in an ideal situation or quickly detect any plan errors. So if you don't have processes documented, I would really recommend starting to think about that.
So if I'm a plan administrator, I really want to follow the letter of the law and also avoid a DOL or IRS audit that you mentioned. What type of resources are out there to me to avoid some of these plan errors that you're saying are being targeted?
The IRS has some great resources to utilize, and their website is actually really user-friendly. One of the resources they have is the plan sponsor's responsibility listing, and basically this is just a high-level look at what you should be doing as a plan sponsor, so it's a really good starting point for you. They also have another resource that's IRS Fixing Common Plan Mistakes. So obviously you don't want to be to the point where you're fixing mistakes, you want to be able to prevent them, but this is a really good tool to use to see, okay, what are the IRS, what are they noticing, and so that can give you an idea of where you need to start as well. And then I think I mentioned previously that the DOL has a great article related to understanding retirement plan fees and expenses that are a really good starting point for those as well.
I would say on top of those items, I would also recommend a resource that we use quite frequently is the AICPA Audit Quality Center. It seems like it would be more for us, but quite honestly, I've pulled several documents from there that I've provided to clients and to plan sponsors that answers a lot of questions, whether that's selecting a service provider, what types of questions to ask, whether it's monitoring your plan. Maybe it's just a description to help you better understand. Maybe you have some alternative investments that you're just not really sure what they are. So that's always a great starting point. There's a lot of information out there. Again, it's just a great resource that you can find checklists. You might even find something you didn't expect to find that just helps you run your plan better. Another great starting point with this, I would just say your plan document. We've touched on amendments to your plan document, but I would just say clearly understanding your plan document. And if it's been 2+ years since you've opened your plan document and looked at it and read it in detail with your investment or retirement plan committee, I would say it's time to open that back up again, because we've seen several instances where a sponsor may think the document says one thing, there's been turnover in the department, and the document says something completely different that they did not expect it to say. So again, a lot of DOL IRS questions are going to be driven by, what does your plan document say? What did you tell your participants? What benefit are you providing? And are you holding true to that benefit? So on top of all the other resources, probably the starting resource that you want to start with is your own plan document. Does it say what you want it to say? And is it current? So again, if you haven't looked at that in a while, I would make it a routine process to look at that document.
And I would just add to that too, with the adoption agreement and the plan document, those may not be documents that are getting distributed to your participants. What is getting distributed to them is oftentimes the plan summary. So I just think it's really important to make sure that your plan summary, which is what you're communicating to your participants, mirrors what's in your plan document, and there aren't discrepancies between the two.
And Shalane, a good way to make sure that you're doing all of these things is to consider doing a self-audit of your plan once a year. This will help you avoid plan errors in the future. It'll also help you get prepared for your annual audit that's required as part of your Form 5500. And the IRS is just about to release a questionnaire self-audit tool that you can use as a guide for this, so look out for that.
One thing that we haven't really mentioned during this section is the 5500. And I know a lot of plans have a third party that prepares that 5500 for them. What is the plan administrator's responsibility for that if they're paying someone else to prepare that?
Well, you have to remember that Form 5500 is yours. It's not your service provider's. So if there's a mistake on it, the DOL and the IRS, they're not going to go to your service provider. They're going to go directly to you. So if it were me, I would be making sure that I reviewed that Form 5500 and I understood what every single question, what every single answer meant on that, and that I was comfortable with it. Remember, at the end of the day, you're responsible to Form 5500 and everything that's included on it.
And I would also emphasize, Danielle, you're signing the form. So the expectation is if you're signing the form, you've read through it, you understand it, and you agree with the responses regardless of who prepared that form. No different than your income tax return. You're still signing the form. Somebody else may have prepared it, but you have a huge responsibility for the information that's included in it.
So we've been through a few, but are there any other areas that DOL and IRS are also focusing on?
The only other item that I really wanted to mention quickly is the IRS uses a system of cycles for applying for IRS determination letters. And the first set of cycles began to expire January 31st, 2012. So I would recommend just taking a moment and looking at your IRS determination letter and just making sure it's as up to date as it should be. And if it is just getting ready to expire, that can be a pretty lengthy process as far as applying for your new one. So you want to make sure you're getting in front of that.
Now, if plans have a prototype plan, is that something that the plan administrator is responsible for, or is that something that they should be expecting to hear from their third-party administrator about?
Well, the plan administrator is responsible for ensuring they have an IRS determination letter. As far as applying for it, if it's a prototype plan, their third-party administrator would be working through that for them, and then they can just adopt that IRS determination letter. But once again, you want to make sure that you're in front of this and you're communicating to your third-party administrator.
I would also say other areas that they're focusing on. They're using technology a lot more through these processes. With the implementation of the EFAS system, they're able to use that for analytic tools to pick things that just look odd with the plan financial information. So again, we talked about audits. A trigger for an audit may be some analytic tool that they've implemented that some gain or loss or some type of expense doesn't match up to what they would expect it to be. So all of a sudden it red flags that plan, and now you're selected for an audit. So they're trying to use this information that they're having everyone input now to better manage the plans and better focus their audits on the plans that they think they should be auditing. Another example of how they're using technology, and this is more in our world, is the DOL is comparing their lists or their database of what audit firm signed off on the Form 5500 and did the audit, and they're matching that up against various state boards or the AICPA database to actually compare and say, okay, did that firm have a peer review, and are they even able to do audit employee benefit plans? And surprisingly, what they found is there's a lot of audits that have been done by firms that should not be doing employee benefit plan audits. By that I mean they haven't met the qualified peer review standards. At McKonly Asbury, when we go through our peer review, they select our benefit plans for audit as part of that peer review. And that's what every firm that's signing off on a 5500, on any opinion on a employee benefit plan or a 5500, should be going through the same process. And by matching those databases up, they're finding that is not happening. So again, heavy use of technology, I would only expect it to increase. I would only expect the audits to become more focused based on their analytic tools and their comparison of various databases.
And Dan, just to tack on to that, in the presentations that I've been at by the state board, I don't think that it's necessarily intentional by these firms, but I think some of them didn't realize that it was considered an audit, since so many of these limited scope audits actually issue a disclaimer rather than an unmodified opinion. So I don't think it's intentional, but I think that these firms are thinking, oh, I only issue a disclaimer, so I don't necessarily need a peer review. So it's just something to watch out for. And if you're unsure, it may be worth asking your audit firm if they're having a peer review of their employee benefit plan audits. So we've talked about a lot today, and it seems like there's a lot to remember when sponsoring a 401k, and a lot of responsibility as well. Why is there so much continued scrutiny and regulation of 401k plans?
The bottom line, there's just a lot of risks with these plans. As you see from the several topics we discussed, there's so much scrutiny because there's been so many opportunities for employers and sponsors not to do the right thing. So the DOL recognizes that, whether it be from lack of resources internally at the plan sponsor or bad selection of service providers, they recognize that there's a lot of risks and there's a lot of places that things could go wrong. The bottom line is you've taken a participant's money out of their paycheck, and the DOL, the IRS, expect you to do the right thing with that money, and timely, as we've hit on. So whether that be for fees or administration or any other matters, there's risks from start to finish with the process and with sponsoring a plan. So with that being said, you have a lot of people helping you with your plans, a lot of resources and a lot of money that you spend to manage your plans, whether that be for your audit or your attorneys or your investment advisors. My recommendation, our recommendation, is to make sure you're using all these resources. Understand what each person's doing, as we've talked about before, because the better you understand what their role is, the better questions you can ask them to make sure you're doing your job correctly. So the list goes on. And as we've said over and over again through the presentation, the DOL from my perspective, is not just they're not out there just to get people. They want to get things right. They're trying to put resources out there to help you, and we want to do the same. We want to help our clients get things right. So if you have questions, please ask us. But for that concludes our presentation. We are going to provide an opportunity for questions and answers. If you would prefer to ask us questions offline, we'll also provide our email addresses and phone numbers. You can ask us that way as well.
Thank you again, everyone, for spending a portion of your afternoon with us. We did receive a few questions during the webinar, so without further ado, we're going to go through some of those. The first one we have is, does ERISA give any guidance on how long you should keep records related to the plan?
Shalane, I can take that one. Basically, ERISA says you should keep on file any documentation you need to support current plan operations. So, for instance, if you have an employee who may have terminated, you still want to maintain documentation for them if they're still a plan participant.
Thanks, Danielle. Our next one, during the webinar, you mentioned performing a self-audit. What steps should I go through if I want to perform a self-audit for my own plan?
Shalane, I'll take this one. There's many steps that you can actually follow through for a self-audit, and it's going to be unique to each organization. But there's a few things that you should at least consider for your self-audit, and that's number one, looking at documentation of your process. So whether you have your processes and all the key processes related to your plans documented, that typically helps identify any risks or problems within your processes themselves. Once they're documented, walking through those processes and key components just to make sure that how things are actually functioning are actually how you documented them. You can also sample transactions similar to what we do for the audit of the benefit plan. Look at a few examples of contributions and amounts taken out of people's paychecks, how they're processed through the system, and how those contributions are remitted to your service providers. Another key thing that we've also already hit upon is reviewing the plan document. So again, we've already hit on this point, but just focusing on this for your internal or your own self-audit is helpful as well. So reviewing that document. And lastly, a big component of the self-audit is making sure you look at your internal control reports or your SSA 16 reports that your service provider sends over. You will note in all those reports, they include things that you cannot rely on solely for that report. So things that controls that you need to have within your organization for the report and the controls at your service provider to function properly. So you want to make sure you understand what you need to do from that perspective.
Thanks, Dan. Looks like our next question is regarding timely remittances. The question is, we finished processing payroll on a Tuesday. Payday falls on a Thursday, and we then deposit the 401k withholdings on Friday. Is that remittance okay?
I'll start by saying that should be okay. There should be no problems with that. But again, it goes back to the comment we had, as soon as administratively possible. So if that Friday, the day after, is as soon as administratively possible, and that is the trend you set with your plan, then yes, the answer is that will be okay.
At this time, I think that's the last question we have. So we'd just like to thank you all again for joining us. And as we mentioned previously, if you have any follow-up questions, please don't hesitate to reach out to one of us via our email, which will be posted on the slides on our website later. So enjoy the rest of your afternoon.
Thank you once again for joining us for this presentation produced by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thanks again and have a great day.